very warm good evening to all who have gathered here today. Thank you very much for your support. So today's topic in this series of Right Wing Talk, we have chosen the recent tax changes and what could be the possible tips for doctors to save taxes. Yeah, so let's begin. So the agenda for today is we'll see why is it special, where for doctors. So any financial advice, why is it different for doctors? What are the recent tax-related changes? And what are the changes to investments as per the latest budget announcements? What are your tax saving options? What should you, as a doctor or a medical professional, should look for in order to optimize your tax outgo? And lastly, we will have a Q&A session where you can, have your questions answered. So let's begin this session with a small, poll question. This will help us all to understand what we want to take away with today's session. So what is it that triggered you to join this session today? Sanjay, can we please run the poll? Request you all to kindly participate in the poll question. Thank you all. Yeah, I see some more responses coming in. Yeah, thank you very much. So this session is specifically for doctors. However, many of them have joined for knowledge as well. So you're welcome. You're always welcome for this session. So let's begin. So going to the first aspect of why doctors need a special advice, right? It is very well known that doctors have a very busy schedule. The first thing is they start their career much more later than what we others normally do. Our tax planning, our investment planning, and somehow our retirement planning starts in our 20s. But for doctors, because of the longer duration of education, longer duration of training, professional training they undergo, there is late start of their career and late start of income as well. However, when their income starts, it is, there's no looking back. They start earning really, really well. And somehow, because of the delayed income and delayed career, there are delaying other aspects as well, like tax planning, retirement planning, savings, investments, which take a backseat because they are trying to figure out where do they fit in, whether they should, employ themselves with the hospital, with a good hospital, or whether they should start their own practice, or whether they should be doing both of them. So in a time where they, start deciding and settling down, another 5 to 6 years are gone. So last month we had a webinar where it was a panel discussion with some of the doctors, and the most common thing that we came across was most of their planning or most of their trigger point when they start thinking about having control of their financial things starts usually at their 40s, which is very late when compared to other professions. So that is why the special need, special advice is required because of the loss of the time period. They have very bigger goals, they have good income, they have bigger goals, but then they do not know whom to approach, how to approach, and how to go about it. In most of the cases, they tend to rely on the advice that they get through their friends, their family, their peers, or their colleagues, and that which might not be suitable to their financial goals and objectives. So these all parameters makes it very a special segment where, as we as financial advisors need to focus and make it a little differently and make it customized for doctors. So typically for doctors, these are the different sources of income. One is their income from profession. That is, if they're having a consultancy income, like they're working with hospitals, 2 or 3 hospitals as consultant, that is known as consultancy income. That is one form of income for doctors. Another is if they're employed as a full-time doctor with a hospital, that is their salary income. They also might be engaged in delivering lectures and speeches in various conferences and events, which gives them a fee as a speaker and a salary as a lecturer. So those are the income sources. They might have invested in a lot of real estate property because that is one of the favorite or most go-to investment options for doctors because of the lack of time and tremendous wealth getting accumulated. They won't just want to park it or have a physical wealth physical investment. So they just go in for real estate. So it could be possible that there are real estates where they are earning a rental income. So that could be a possible source of income for them. And then there are other earnings, because of the lack of time and things like that, they might end up just parking their money in FDs, which gives them interest income. Some seasoned doctors who are interested and who are able to find the time to invest in some good quality shares and shares, they also get dividend income from them. So those are the typical sources of income. So before we start delving into tax planning, it is very important for medical professionals or doctors to understand the importance of a good financial plan. So, if you are someone who has not yet started your, financial journey, your financial planning journey, your tax planning journey, we suggest you consider having a good financial plan created by a professional, which gives you a roadmap, to look at, to take a bird's eye view of your situation. Down the line, how your future looks like. First of all, it helps you understand where you stand today in terms of your assets, your incomes, your expenses, what is your cash flow, right, and what you need to do to achieve your long term and medium term goals in the future. So whatever choices you make today will impact your financial future. So that's why having a good holistic financial plan, which touches upon the 360 degrees of a holistic plan, is very, very required, especially for doctors for whom there is considerable amount of time which is gone. A good financial plan is a plan which helps you plan for your contingencies, which helps you understand what if there's a worst case scenario, how best you are protected and your loved ones are protected with the resources that you have today. Right? It talks about and ensures your cash flow management, your investment management, considering your risk appetite, your time horizon that you have in hand. How can you plan your investments? Tax planning. Tax planning is just one segment of the overall financial plan. So tax planning again helps you understand how you can optimize your tax outgo so that you can increase your take home income, and simultaneously the tax saving investments that you're making should be in line with your overall objectives. So that is what is called tax planning, which comes as a part of overall financial planning. Then your insurance assessment. What is the risk that you as an individual face? What is the risk that your dependents face because of you? What is the professional risk that you have? So the risk to your life, your health, your dependence, to your property, and to your career. How can we assess that, and how do we overcome that? So that is something called as insurance assessment, which is an integral part of a good financial plan. Then comes estate planning and retirement planning. Retirement planning, of course, goes hand in hand with other goals planning, which is one of the important and most important goals, because for everything else, we tend to get a loan. We get a loan for constructing a house, we get a loan for education. If we don't have enough for our kids' education, you can always go for a education loan. But for retirement, we don't have a plan B. Whatever we are doing today will ensure that our post-retirement days are peaceful and non-dependent on anybody else or anything else. So that is retirement planning, which is also a good portion completely concerned in the financial plan. Now, before we begin with tax planning, I would like to understand the thought process of our audience today. What is tax planning according to you? Sanjay, can you please run the poll? It's wonderful to see that there is no one in the audience who says, okay, we have one. I don't understand tax planning. That's good. So that is why we are here today. I hope this session helps you. Some of them have answered for do whatever my CA says. Yes, CA is a good consultant who can advise you on tax planning. Buy some investment products from bank or insurance, yes, but that might be like a last minute thing for I will take you through all of these aspects. Consulting a professional advisor for overall planning, yes, 35% of them have given their response there. And making informed investments throughout the year, yes, I'm happy to see that there's a mix of response. Let's get on with the session. Yeah. Um, what is the importance of tax planning? So, why does someone have to do tax planning? This is very important to understand, before, and this is the right time to understand this because we are in the beginning of the financial year. Okay, smart tax planning is the key to financial success. If you want to ensure that all your financial goals are met, or your retirement requirements are met on time, then you should have tax planning as an effective exercise every year in consultation with the financial plan. So, financial plan and tax planning both have to go hand in hand, and the overall objectives need to be considered every time you make a tax planning investment, right? So, as per the words of Benjamin Franklin, he says that nothing in the world is said to be certain except death and taxes. So, taxes will always be there, hence, it is important to learn how to effectively plan your taxes. First thing that we do with tax planning is to reduce your tax liability, reduce your tax payments so that you have more in hand. So, what will happen if you have more disposable money in hand? This will help you achieve your savings. You will have more investable surplus in hand, which with which you can plan your gold savings. Secondly, it will also ensure that you're minimizing the litigations. If you don't pay your taxes on time, most of the times you ignore it, or you delay it, or things like that, and you don't do it effectively as required by the law. You end up engaging in a litigation. So effective tax planning helps you avoid any kind of litigations. Productive investments. So, with the help of tax planning investments, it is also important to choose those investments which are in line with your overall requirements. For example, in ATC, we have lot of options for investments. There are insurance policies, there are ULIPs, then term insurance is also there, right? Provident fund contributions, PPF, uh, NPS is also there nowadays, right? So, what is it that helps you not only save tax but also helps in your overall savings and goals objectives? So, you should have productive investments. Just making the investments in the last minute hastily is not the option, not the right way to do it. Healthy growth for the economy. With paying and planning your taxes efficiently, you're not only helping yourself and your family and your goals, but you're also taking care of economy. You're also helping India to get to the next level. We as professionals, right? So it also ensures a 360-degree economic stability for yourself and your family. We will see step by step how can you achieve that. What are the four tax planning mistakes one should always avoid? One is the procrastination. This is very, very important. Sleeping on it for the first 11 months, and in the month of February and March, just doing some investment, some ATC investment so that I can save some amount of tax is the wrong way to do it. So the investment decisions taken in a haste, right at the end moment, might not be useful for you. It might not be suitable for you, right? You just do it because there's no more time left, and that is not the right way to do it. That is first number one. You should never procrastinate. Start planning effectively from the first month itself, right? Dismissing the magic of compounding. This again relates to point number one. As you delay and you miss out every month or every year that you lose, you're losing out the power of compounding on your investments. Investments tend to multiply every month, every year. So the more you delay, the more you're at a loss with the power of compounding, which again does not help you overcome inflation and have tax efficiency overall. Not exploiting relevant provisions astutely. There are other sections other than ATC where you can look at making some tax saving investments, or there are a lot of provisions apart from ATC. There is section 80D, 80DD, 80G, right? So all those can be a part of tax saving exercise that you can do if you are in a higher tax bracket. Picking unsuitable tax saving investments. Let's say you just end up buying any insurance policy, let's say endowment or money back, just to show that you're doing this tax saving investment. That might not be the amount that you invest might not be useful for you at a future time, given the inflation rate, given the growth rate of that investment and things like that. Whereas if you had bought a term plan rather than going with those investments, that would help you achieve two objectives. One is you're protecting your life insurance. You're protecting your loved ones against if something happens to you. Number one. Secondly, you can also take tax benefit with that term insurance policy. So you have to understand what really is a need of the hour for you before making any tax related investments. Now, what are the recent changes that were announced in the recent budget 2023? There are five important income tax rule changes that have come in. One is the first one is the tax rebate limit has been increased. Earlier, the tax rebate limit was applicable only to people who are earning up to 5 lakhs of income. Now, this has been increased to up to 7 lakhs. Now, people who are earning up to 7 lakhs can also avail this one-time rebate of 25,000. That is number one. Secondly, there are changes in income tax slabs. The old tax, you must be aware of there are two tax regimes. One is the old, one is the new. Under the old tax regime, the slabs are the same. There are no changes. However, in the new tax regime, they have increased the slabs to 5 slabs. So we'll look at that a bit later. Then introduction of standard deduction. So earlier under the new tax regime, the standard deduction of 50,000 was not available. What is that standard deduction is on your gross taxable income, upfront you get a 50,000 deduction. After reducing this amount, whatever is in net, you pay taxes on that, right? So that is a standard deduction. So that was applicable only to the old tax regime so far. But after the recent budget changes from the financial year 23-24, the standard deduction is also applicable to new tax regime. Under the new tax regime also people can avail a standard deduction of 50,000. Maximum tax. People who earn an income of more than 50 lakhs a year are, are supposed to pay surcharge. So now the surcharge rates have been reduced as well, where the maximum rate goes only up to 39%. But before these amendments or changes, it used to go up to 42.74%. Leave encashment after retirement. So leave encashment is one very important tool used by people who are about to retire. So they don't tend to take as many leaves, and they see that a lot of leaves are left over. So they encash their leaves. So this was taxable up to 3 lakhs was exempt so far. But now the government has increased this limit for non-government employees, salaried employees also, where you can encash your leaves, and up to 25 lakhs, you won't be charged any tax. So these are the 5 important income tax rule changes that were announced. What is this new tax regime and what are the slabs that we have? So up to 3 lakhs, the incomes are totally exempt. You need not pay any tax on it. 3 lakhs to 6 lakhs, it is 5%, 6 lakhs to 9 lakhs, 10%, and so on. And maximum is 30%. Now, going forward, the new regime will be the default regime unless and until you, officially or formally choose being in the old tax regime. The tax limit the tax exemption limit has been increased to 3 lakhs, as you can see. Earlier, it was 2.5 lakhs. The standard deduction is now applicable to new tax regime also. The highest surcharge rate has been reduced to 25% only. Earlier, it was up to 37%. So this is the new tax regime. So what are some common questions that arise? From when is this new tax regime applicable? It is applicable from 1st April 2023. Does this tax regime have any rebate? Yes. For up to people who earn up to 7 lakhs, we are additionally, other than standard deduction, they are additionally given a rebate of another 25,000 on the net taxable income. So gross taxable income minus 50,000 minus another 25,000. The remainder, what is there on that? You need to pay tax, right? So do I get a standard deduction under this regime? Yes, all the tax slabs get a standard deduction of 50,000. Additionally, for people who earn more than 15.5 lakhs, they are additionally given 2,500 as an additional deduction. Safely till your income is up to 7.5 lakhs, you can comfortably go and choose your new tax regime irrespective of doing or not doing any other investments. How does taxable income up to 7 lakhs have no tax? So you might want to understand, how is it that up to 7.5 lakhs, if I earn, I need not pay any taxes. So you can see here, let's say there is someone who is a beginner, who has just started a career, and the income is around 7.5 lakhs. The standard deduction is 50,000. Then the net taxable income becomes 7 lakhs. Now, as per the slab rate computation, the total tax liability comes to 25,000. On after this also there is a rebate available. The rebate is 25,000. So net you don't have to pay any taxes so far. So that is how it is beneficial, that 7.5 lakhs, up to 7.5 lakhs, you need not pay any taxes. So what are the investment rule changes? So this was what we saw was about income tax rule changes. What are the investment rule changes? There are three very important, announcements that happened. So one is the post office monthly income scheme. Earlier under this scheme, the limit was 4.5 lakhs per single account, per every account. 4.5 lakhs was only account, and if it was a joint account, maximum you would get to deposit there was 9 lakhs. Now this amount has been increased to 9 lakhs per person per account, right? For joint account, it is up to 15 lakhs. Senior citizen savings scheme, the limit has been increased to 30 lakhs now. Earlier it was 15 lakhs. Right. So here also senior citizens who are above the age of 60 years can avail this benefit and park their money if they are totally risk averse and totally dependent on this amount of money, this bucket of money, where they don't want to take any risk with their capital. This is the best option to go for, where you can park 30 lakhs and your interest rate is also quite good, where it is 7.4%. Next is the section 54 and section 54F. This is a section pertaining to sale of house property. So in the case of sale of house property, there are two options that you get. The gains that the capital gains that you enjoy need to be invested in another property, either purchase or construction. And there are some limits. We will see it a bit later. I have a slide for that. So for that, earlier the limit was very less, and now earlier the limit, there was no limit actually. Okay, so now the limit has been capped to up to 10 crores. If your gains are up to 10 crores, then only you can avail the benefits under section 54 and 54F. If your gains are more than 10 crores, then you cannot avail any of these benefits. The TDS on EPF withdrawal is reduced. Earlier, there was, if you withdraw prematurely, if you withdraw your PF, that is within 5 years, and if you did not provide a PAN number, there was a tax deducted at source at the rate of 50%. Now this has been reduced to 20%. So if you are a salaried employee and who has been in the system for 5 years, up to 5 years, within 5 years, right? So if you are redeeming the PF amount for any emergency, you will be taxed only at 20%. That is, if you don't provide a PAN. TDS on interest income of NCDs. Earlier, the interest income which was enjoyed with the non-convertible debentures, listed non-convertible debentures, was exempt from tax. Now this exemption has been received. So whatever interest you will be getting on these NCDs will be post TDS. Now, traditional life insurance policies, where your premiums are more than 5 lakhs in a year, whatever benefits you are enjoying out of these policies will all become taxable if your premiums exceed 5 lakhs. If your premiums are within 5 lakhs, then the exemption is still applicable. So that was one of the important change. The last one, no long-term capital gains tax benefit on debt mutual fund. This was a recent change that we all saw. Earlier, the debt mutual funds had a indexation benefits. That means they were allowed to be adjusted for the inflation. The gains would be adjusted to inflation, and only on the remainder part, 20% would be charged as a tax. Now that has been completely removed. Now debt mutual funds and fixed deposits become the same. The taxability becomes the same. So these are the important investment rule changes. Now, whatever decisions we are doing, for tax planning and interest income planning, we need to be aware of these things. Now, coming to the tips for doctors. Okay, let's see I have some 3 to 4 tips for doctors. Tip number one is presumptive taxation. Now, doctors or medical professions who are earning consultancy income can avail this presumptive taxation. Now, what is presumptive taxation is under this taxation rule, a resident Indian doctor can avail this, taxation provision where the incomes earned from consultancy services is presumed. That means it is your actual profits are not calculated, but whatever gross income you are getting, 50% of that is assumed as your profit, and you need to pay taxes only on the 50% of your incomes. So that is the Section 44 ADA, which pertains to presumptive taxation. So you don't have to get your accounts or records audited. Audit is not required. So this is the best option if you have a consultancy income less than 50 lakhs. It is always better to go for presumptive taxation. Let's see with the help of an example. Let's say we have a doctor, Mr. Pratham, Dr. Pratham, who has his own practice. He also works as a consultant in many reputed hospitals. Now, income from own practice is also a consultancy income. And if you're working as a consultant in hospital, that is also a consultancy income. So let's say he earns an income of 40 lakhs. Now, if he does not go for presumptive tax option, what would typically be his tax output? Let's say he earns, this is a typing error. Let's say it is 45 lakhs, right? And when you're showing your, when you don't go into presumptive taxation, typically you have to show what are the expenses related to your profession, and after deducting that, whatever net remains on that, you would have to pay taxes. Now, let's say he has shown some expenses like work-related expenses, travel and transport, meeting and conference, assistant salary expenses up to 15 lakhs. So his net taxable income becomes 30 lakhs. So now, after applying the tax slabs, his total tax will be around 7.5 lakhs, 7.12 lakhs, right? Now, what if he opts for a presumptive taxation? Under presumptive taxation, straight away he has to pay tax only on 22.5 lakhs because 50% is assumed as expenses and 50% as profit, right? And if we again apply the tax slabs, the total tax will be around 4.87 lakhs only. So there is a total savings of around 2.25 lakhs. So this is an example. So it is always beneficial if you earn less than 50 lakhs, and if it is a consultancy income, it is always better to go for presumptive taxation. What are the benefits of presumptive taxation? It is the easiest way to file your taxes. You need not break your head, ATC, ATT, or any other applicable things. If you do, it is well and good, but still, it is the easiest way to file your taxes because doctors and professionals, they have very less time. This is the best way to go about it. There is no need to pay any advance tax and installments. Just one shot paying your tax dues by 15th of March will suffice. It saves accountant and auditors salaries also, fees also, right? So these are the benefits of presumptive taxation. Tip number 2, like in the previous slide, I was mentioning about Section 54 and 54F, right? So Section 54 pertains to house property. If there is a sale of any house property, that comes under the Section 54. Section 54F is any other, capital asset. If it is sold other than house property, then Section 54F is applicable. However, as a tip to doctors, this is what is applicable. So under Section 54, if you have constructed a house, or if you have purchased a house with a home loan, right? So in that case, you can avail of tax deduction in 2 parts. One is under Section 80C. If you have not made any other ATC investments, then you can claim the principal portion of your home loan EMI up to rupees 1.5 lakhs per year as your tax deduction. Apart from that, on the interest that you pay as in the EMI, up to 2 lakhs per year, you can have a tax deduction. Now, what happens under Section 54 if you happen to sell your property, or if you have more than one property? Let's look at the first part. What happens when you have more than one property? Any individual who has more than one house properties Only one can be claimed as self-occupied. Others will be treated as deemed rented properties, and they will be taxed on the notional rent. Notional rent is nothing but the fair rental value of that property, considering in which city, whether it's a metro city or a non-metro city, or the area, right, where the property is located, the size of the property, considering all that as per the municipal records, what is the fair rental value of their property? On that, you will be eligible to pay taxes on the notional rent. Now, what happens when you sell your property? When you sell your property, you have to invest the gains in two ways. One is either through purchase of property or through construction of property. Okay, the gains, we are talking about the investment of gains only, right? So if your gains are, let's say, 1 crore on any sale of your property, now that 1 crore, you should have purchased a residential house 1 year, either 1 year prior to the sale of this property or 2 years after the sale of this property. If you want to construct a house property, then you have to invest these gains into the construction of another residential house property within 3 years from the date of the transfer or date of sale. Okay. So this is also an effective way of, which a lot of people use to build their wealth. However, there are some pros and cons when it comes to, building wealth through real estate properties. But we can say that a lot of them have benefited using, this Section 54 as an effective tool to save taxes and also to, create wealth in the long run. Tip number 3 is Section 80C. So under Section 80C, you can also choose to go for public provident fund. However, it has a lock-in of 15 years. You can plan it effectively, like let's say you have a small child, 1 to 3 years old. So you can invest in public provident fund for the child's education. So this is a very, very safe, investment option. The interest rates are 7.1%. It varies from 7 to 7.5% every year. The rates change. So that is one option. If you are a salaried employee with a corporate hospital, you might be eligible for EPF. So that is also one of the ways to have your ATC, savings. NPS. So NPS, here additional 50,000 deduction you will get. So every year investing up to 50,000, you will get additional 50,000. That means under Section 80C and 80CCD, the total exemption you can claim is 2 lakhs. That is 1.5 lakhs with ETC and 50,000 with NPS. National Savings Certificates is one. Sukanya Samriddhi account, if you have a girl child within 10 years old, you can invest in Sukanya Samriddhi as a ATC component. Senior Citizen Savings Scheme. This is applicable only for people who are above the age of 60 years. Unit linked pension investment plans, tax saving fixed deposits, equity linked savings schemes. ELSS is one of the best ways to save, make tax saving investments, especially if you are a person with a greater risk appetite, who is not risk averse. So ELSS is one option you could consider. Tip number 4 is HUF, that is Hindu Undivided Family. What are the tax benefits of having a Hindu undivided family? Let's say there is a family and who has 2 doctors, and both the doctors, run their own business or practice. Now, what happens when they create a HUF? When they create a HUF, HUF in India is treated as a separate legal entity. That means it is treated as HUF is treated as any other individual when it comes to taxation. So its members can avail of certain tax benefits that are not available to individuals. Okay, so simply put, it is treated as another person. So let's say you pass on your incomes to HUF, then a part of your, if you are in a high income bracket, if you pass on a portion of your income to HUF, you can avail of the tax benefits, the ATC benefits. You can make ATC in the name of HUF, and you can avail tax benefits there and reduce the tax outgo. You can plan it with the help of an HUF. The income of the HUF is again taxed similar to the what individuals we have the tax slabs. The same is applicable to HUF also, because it is a separate legal entity and taxed individually. And other key benefit of having HUF is that HUF can also own its own residential property. So if you have 2 or 3 properties, By creating HUF, you can transfer one property to HUF, where HUF can claim it as a residential property and take exemption of one residential property for tax purposes. And home loan can also be availed under the name of HUF. So if you want multiple, if you have plans to build multiple properties and multiple home loans, one can be passed on to the HUF also. Finally, another important benefit is the HUF members can avail certain exemptions and deductions under the Income Tax Act, which are exclusively available for HUF. So these are some 3 to 4 tips you can use to save taxes as doctor or medical professionals. The other tax saving options other than Section 80C are 80CCD, like I mentioned, that is NPS. Any individual can have an NPS account. NPS is an investment which is market linked. You can choose how aggressive you want your investments to be, how moderately aggressive or highly aggressive you want to be, and whatever contributions you are making to the national pension scheme, up to 50,000 of it is tax exempt. So in total, you get a 2 lakhs exemption here as per ATC and ATCCB combined together. Other than that, you can also look at having Section 80D, that is medical insurance for yourself and your parents. For yourself, if you have medical insurance, and you pay premium of up to 25,000, so up to 25,000 you can take as a deduction from your gross salary for yourself. Additionally, if you're buying a health insurance for your parents, up to 50,000 premiums can be shown as a deduction, and deduction can be availed. Section 80G, limited to 10% of your gross total income. You can make some donations to which are recognized and authorized by the government as tax saving donations, and take a certificate and show that you have given these donations and avail your tax, tax exemption. To avail tax exemption, there is a cap here. You can invest only up to 10% of your gross total income. Section 80E, again, this is pertaining to education loan. So if your child, is going for higher education, you can look at partially funding it with, your funds and investments, and partially with education loan, because you can also avail deduction for education loan. For a doctor, your profession is not limited to 60 or 65 years. You can continue as long as you want, provided you're healthy and able to do it. So in those cases, you can avail this 80 education and show that you are paying education loan EMI for your child, and you can avail this benefit. Home loan tax benefits, yes, we have already seen this in the previous slide. So these are the major tax saving options you can consider. Now let's look at how ELSS is a better way to do a tax saving investment. Now, younger people who are able to take some amount of risk might look at considering equity linked saving schemes as a tax saving instrument. So what is the benefit of having ELSS is it comes with a lock-in period of 3 years. So if you invest, let's say, in an ELSS scheme, you have to be invested or stay invested in it for a minimum of 3 years. This is still less as compared to other, tax saving investment options like tax saving FPs. Minimum 5 years is the lock-in period. PF provident funds have 15 years lock-in period. Policies have minimum 10 years. Insurance policies have minimum 10 years lock-in periods and things like that. So this is still a liquid way of doing your tax saving investments. Growth potential of equities. Irrespective of what risk you take, right? So the growth potential is at least 12 to 15%. You get returns up to 12 to 15%, which you can consider for your long-term goals planning as well as tax savings, right? So effective tax savings with ELSS funds is possible. Option to invest through SIP and benefit from power of compounding. In ELSS funds, you have option to start in a SIP mode also. Like if you are unable to do it, a one-time lump sum, you always you have an option to do it month-wise. So let's say in April you do 1,000 or 2,000 rupees or 10,000 rupees. It's your choice. You can do it however you want with the help of a SIP. And this will help in cost averaging also, just like how you invest in mutual funds. Cost averaging benefit you will get, and power of compounding is of course always available. You can continue the investments even after the lock-in period. You don't have to withdraw it at 3 years. You can leave it there for it to grow, and you can choose to invest in another, ELSS for the next slab of 3 years. So those are the benefits of having, ELSS as a tax planning investment. So why do you need to have a good financial plan? First thing to consider is financial viability. Financial viability comes with assessing your risk profile, what investments suit your short term, medium term, and long term goals, and how to have tax efficiency, how to ensure tax efficiency with these investments, and also to ensure that your post retirement incomes are tax efficient. So, all that is a part of a good financial plan. So, it is always better to consult a professional advisor and create a holistic financial plan and go ahead with tax planning, which ensures your financial viability. Whenever an advisor, a financial planner is creating a plan, they always consider inflation, right? Now, inflation is not the same for everything, right? For living expenses, the inflation is about 6 to 7%. For health and medical requirements, the inflation is much, much higher, maybe 10 to 12%. It is the same for education also. The education costs in India have risen tremendously, and we need a fortune for to send our kids to their desired career paths. Right. So inflation, calculating what amount is required for your goals and how to reach that corpus is a tedious and a very important exercise that one should do with the help of a advisor and with the help of a financial plan, which considers the overall inflation impact not only on your present but on your future incomes also. What is the contingency planning? Like planning for your risks, creating an emergency fund, creating a medical corpus for yourself, for your parents, in case you are in a health condition where you are not able to avail a health insurance. Then what is the alternative you can look at? You need to build a corpus, separate corpus for your contingency health emergency requirements, and how much that amount should be. So all those calculations and planning an advisor is capable of doing, right? And how to plan your retirement. How much do you need in your retirement years is a very, very comprehensive calculation that goes behind. And you should always plan for a little bit higher, because um, it is always better to have more to plan for your longevity. Because what if you tend to live a few years more, right? So your corpus should be able to suffice during those periods also, so that you're not dependent on your children or anybody else, right? So what is that corpus that you need ultimately up to 80 years, 85 years, or up to 90 years? Whatever is left, of course, goes as a legacy to your loved ones, right? Insurance planning, like for your life, health, and your profession. And now, along with insurance planning, one important aspect we all need to consider is, let's say, um, you are constructing or purchasing a dream house of your own, and you're taking a big hefty loan, assuming that you're on a good career path, your incomes are growing and you'll be able to do it. But at the same time, if something happens to you, your loved ones are at risk, right? So it is always important to protect your home loan with the insurance. There is something called as home loan insurance. So if something happens to you, the insurance will pay the remaining loan. So that is number one. Secondly, you have to ensure that you have ample life insurance, that whether if something happens to you, your family takes care of all the important financial goals in your absence. Number three, disability, accidental death or accidental disability benefit, right? So you should have a good term cover with accidental death benefit rider, with partial disability rider, permanent disability rider. So these are some important tools and techniques one should avail. Again, it goes with the calculating the need, like what is the need, what is the ample amount, correct amount of insurance that one needs for to to ensure that all are protected, right? So that is one important exercise a financial plan will help you to do. All the investments are tied and mapped to goals. So a good financial plan will help you to have a bucketing strategy, like how much you should be saving for your next travel trip, the next vacation, maybe how you can plan your vacation, whether it is every year, whether it is alternate year, whether it is India travel, abroad travel. Similarly, how can you plan for your next big goal, whether it's a house construction, a house purchase, a dream house purchase, or dream car purchase, how to plan for your child's education, and what set of investments you should be looking at for your child's education, for your retirement. So, all this is a part of a good financial plan. Cash flow management is simply what cash flows in and what cash flows out of the family every month, every year, and what is left at the end of the year as investable surplus, and how to effectively plan these, directing towards tax planning and directing towards goals planning is one another important exercise, that is cash flow management. And how do you achieve all your financial goals considering all of these as a overall consideration, and what is your ultimate financial success strategy that you should be looking at is covered in the financial plan. So it is always better to plan, because if you fail to plan, you are planning to fail. So it all starts with a good financial plan. Now, tax planning is an important element of a overall financial plan, um, where you are ensuring that not only you are planning your taxes, you are also ensuring your risk elements, your future goals, your retirement, and also your risk appetite. Based on your risk, what is it that you're doing, considering the taxes, considering your corpus requirements, investments, the growth, and everything, right? So always understand that these are some key points which you all should keep in mind and work towards. How to manage your spending and prepare a realistic budget, and what are your ways to save, whether it is monthly, whether it is half yearly. It all depends on the cash flow. What is the cash flow that you expect every month, expect every year? So how do you manage your spendings out of that, and how do you prepare a realistic budget and stick to it? How do you manage credit or loans, and how do you pay off your debt? Within what time span you should be paying off your debt? Because typically after 50, 55, as advisors, we do not suggest keeping any loans or any commitments after 50, 55, right? So what should be that strategy to pay off your loan which you have taken for your dream house, your dream car, and what you should be doing with that, right? How to invest to make your money work for you, right? So if you don't plan for this, you will end up working till the end. And whatever money you're making without planning, see, it's like a goal without a plan is like shooting in the dark. You don't know where you're heading. So it is always important to ensure how you want your money to work for you, as a backup, as a plan B. How to plan your taxes, how to plan to reach your financial goals, and how to protect yourself from fraud. This is also very important. How to not get missold. What are the right set of questions I should be asking to a person pitching a product to me, whether the product is relevant to my goals, my financial plan, and my overall objective, right? So the benefits of having all of this is you will have a better control on your finances. You will have a better control on how your future should be, financial future should be. You will ensure that you are achieving all your desired goals, your basic financial goals also, and your aspirational goals also. So you're not only doing this for yourself but for your family, and this also reduces stress and a better sleep at night. So always remember that a good plan will ensure that you are at peace, no matter what. You don't have to think of making ends meet, or just earning for a living and things like that. So always have a plan. So now, what are the key takeaways out of this session today? So if you are a salaried person and you have ATC investments and a home loan, always opt for a old tax regime, so that will be beneficial for you. If you don't have any ATC investments or any home loan, then it is always better to go for a new tax regime. If you have a consultant income less than 50 lakhs a year, opt for presumptive taxation under Section 44 ADA. This will save ample amount of taxes for you. If you're above 60 years of age, consider having post office monthly income schemes or senior citizen savings schemes as a debt allocation, because the interest rates are quite good, and you can invest higher amounts there. If you have business income or self-employed with income more than 50 lakhs, you should, this will be treated as your business income, right? So where you have to declare your expenses and then calculate your profits and then pay taxes on your profits. The best way to optimize this tax outgo is to consider having a HUF. Again, if you have a complicated family scenario of too many members, then consulting a good advisor, CA or a tax expert for going for HUF will be advisable. Tax saving investments need to be aligned with your overall financial plan and objectives. This is very, very important. So with this, we end our today's session. Thank you very much for your time, and hope you liked this session. And now we are open for Q&A. Let me brief you before we take the Q&A session. So Right Horizons is a wealth management boutique firm at Banerghatta Road in Bangalore. And these are some of our services. We run a family office services, wealth management and portfolio management service, NRI investments, financial planning and advisory, and corporate advisory as well. So if you're looking for any of these services, if you're not able to handle on your own, if you don't have time, and if you're looking for somebody, then you can reach out to us at these contact details. So yeah, so I can see a couple of questions. Yeah, is any GST applicable on doctors? This is very subjective. I'm not sure how to put it across. I will get back to you on this later, maybe on our email, right? Okay, there's one more interesting question by Viral. In the month of April 2023, if I purchase a life insurance policy of 5 lakhs premium, and in the month of January 2024, if I purchase another policy of 3 lakhs premium, which insurance policy IT department will consider under section 80C? Okay, so I think they will club, because the total premiums that you pay in a year should not exceed 5 lakhs is what we have read and understood. But let me get back with a better clarity on this later.